Hello friends, welcome to CEC Live Lectures. Friends, today in this session we are going to carry forward our series on behavioral finance. Today we are going to talk on investors' behavior in detail, and for the discussion on the topic we have with us in our studios Dr. Divya Verma-Gakkar. Dr. Divya Verma-Gakkar is an eminent professor. Currently she is Assistant Professor in School of Management Studies, Guru Gobind Singh IP University. Dear friends, she is a prolific professor who believes in giving her best to the students, and whatever she has earned, whatever knowledge she has gained through her academic career, she believes in giving to her students. Friends, if you wish to ask questions from Dr. Divya Verma-Gakkar on today's topic, then do call us through our toll-free number. Our toll-free number is 1800110430. I repeat, our number is 1800110430. You all are requested to call in the last 10 minutes of the lecture only, as well as you are kindly requested to ask questions relevant to the topic. Now, I would like to welcome our guest, Dr. Divya Verma-Gakkar, once again. Hello, ma'am. Welcome to the session.
Thank you so much. Dear friends, today we'll talk about investor behavior. As we all know that investment is being done by human beings, and being in a corporate organization or being in a for investment for our own self as an investor, it is human behavior which plays a role while taking all type of decisions. So, investor behavior is very complex, just like understanding human behavior is very complex, because it is affected by our personality, it is affected by our experiences of life, affected by our things which have happened to us in the past, our peers, our society, culture. So, all of these things have an impact. The attitude which we develop, the habits which we have gained over years. So, all of these affect the investment behavior, and they also affect any human being in any type of decisions they are taking in life. Today specifically we will be talking about the behavior of human being with respect to investments. So, our focus will be on talking about various types of investors, how we can categorize the investors. We will be talking about the factors which influence the investor behavior. We will talk about the factors which affect or influence the personality of a person, and we will also talk about the biases which are affecting the investor behavior. So, investor behavior attempts to define the psychology of investor while making investment decisions. Investors use their mind and logic while investing in any security or portfolio. Investor behavior elaborates the reason and biases due to which there can be mistakes in judgment and evaluation of a security. Investor behavior can be defined as reaction, attitude, action of investors in a particular or combination of situations which are available in the market or implied by the knowledge and experience of an individual. Now, while taking investment decisions, we have seen that investors take decisions based on reasons and logics. The decisions of individuals regarding investment are affected by various mental processes, attitude toward risk, personality, emotions, and many other internal and external factors. In general, while studying investor behavior, we can understand various biases which arise due to human psychology and their impact on the investment at the micro level as well as at the macro level or the financial markets level. Now, let us talk about the various types of investors. The classification is based on investments. So, various type of investors can be classified as overconfident investors and status quo investors. Overconfident investors are those who are sure that their decision of chosen security irrespective of unfavorable market conditions. They may earn huge returns, but from there is an equal chance of losing all the money. Such type of investors, they overestimate their quality of information and their ability to predict future conditions. Second type of investors are status quo investors. Now, who are status quo investors? They are opposite of overconfident investor. They will stick to the status quo, they will stick to whatever investments they have despite having extra gains or losses which they face in the process. They display lack of attention while managing their portfolio. They often underestimate their decision making skills and are reluctant of taking any risk. Studies have shown that women are less confident and stick to their investment for longer as compared to men. Another way of classifying investors is on the basis of nature and trading style. Investor can be classified as active investor and passive investor. Active investors take regular interest in the trading of the market on regular basis. They change their portfolio from time to time. They may not trade on daily basis, but keep an eye on securities daily and record the fluctuations. They do not hold the security for long time unnecessarily. Second type of investors are passive investors. Passive investors are lazy investors in the financial markets. They do not go for the decisions which involve high stress and require investing a lot of time. These type of investors either invest in mutual funds or go to the traders to manage their funds. Passive investors are not experienced and often hesitate in taking crucial decisions. So, passive investors do not take active interest in investing their own money. They rather use money for investment by taking help of others. Another way of classifying various type of investor is on the basis of objective of investment. Now, on the basis of objective of investment, investors can be classified as regular investors. They are those people who have been regularly investing for a long period of time and they want to save for some unforeseen events which happen to them. Only savers, they are those investors whose aim is to make investments to have savings for a better future, and their purpose is to save in the market or save in such instruments which are risk free, like invest in fixed deposits, public provident funds and other safe investment instruments. Third type of investors are seasonal traders. Now, seasonal traders do not invest frequently, but when they do, they will invest large volumes. These investors wait for the right opportunity to allocate their money in the right security to get maximum gain from that. Another type of investors are angel investors. Now, these investors are wealthy. They invest their money to support new ventures like they are like private equity firms, they are like venture capitalists, they are also known as angel investors, where one successful business is supporting another new firm during the initial phases of the life cycle of the firm or during the time of difficulties. There are business investors who help flourishing one business or the other business, and they help each other by investing in the equity capital of the business. There are risk taking investors. These are the investors who take lot of risk in the market and they are confident risk takers and are leaders of the market. Now, based on the investor behavior, we also need to understand that what will be the behavior of an investor based on the objectives when he is investing money. For what reason a person is investing money? If as an investor we have to save money, is my objective to ensure safety of my capital? So, people who are retired, who have who have to save money for their retirement future, so they invest their money for safety purpose. Another objective can be growth. Now, those people who have interest of increasing their capital, so they would invest in growth type of investments. So, one such objective is safety, where no option is completely safe, but these are the preferences which are opted by the risk averse investors. The risk averse investors, their main objective is to keep their money safe and to earn a minimum rate of return on their capital. Second category of second objective can be growth. Now, those people who want to invest money in the market in the expectation of capital gain in future, and they want their money to grow along with being safe. So, that can be another very important objective which people have in mind while investing money. Another third objective of investment can be generating income. So, people can invest money in a way in some type of investment venue, so that they keep getting regular returns on it. For example, on a bank fixed deposit you get regular returns, or you can buy government bonds, or you can buy equity shares on which you get regular dividend or rate of interest being paid annually or monthly or 6 monthly, like that. People do invest money for the purpose of tax exemption. So, people buy some of the products so that they can get tax exemption for the purpose of income tax. Then for the purpose of liquidity also people do invest money, where they want to save their money for a short period of time, as and when they want to liquidate it, they should be able to liquidate it. So, such investment can be made in money market instruments, such investment can be made in equity shares or in ETFs, that is exchange traded funds, which can be easily liquidated. Investment can be also made for the purpose of fighting inflation. Now, we all know that money has time value. If the money which we have, the money has a purchasing power, which with the rise in the prices of commodities, the value of the money depreciates. So, because of that, people do not want to lose their purchasing power of the money. So, they want to invest it in some type of investment instruments. Another objective, very important objective for investment is that we have some financial goal in terms of meeting some long term financial expenses. For example, a person can have an objective of saving money for or investing money for the purpose of buying a, let us say, a house after 10 years, or somebody wants to save money for the marriage of their children, or somebody wants to save money for higher education. So, whatever is your long term objective, so if that is clear, then accordingly your behavior will also be different. Now, talking about what are the factors which influence investor decision making, there are internal factors which affect the decision of the individual due to his own judgment of choosing the type of security. In other words, the investor is in control of these factors. So, the factors which affect the decision making of an individual can be classified into internal factors, external factors and situational factors. So, talking about the internal factors is one such point is emotional attachment. The attachment which a person has towards a particular stock also affect his decision to invest in that particular stock or that particular investment avenue. Now, what is the attitude of the person? The attitude of a person determines their choice of stocks. Some investors are risk averse while some are risk takers. Risk taking habit of investors attract them towards the stock which will give them extra benefit, but at the same time involve high risk, while investors who do not want to take risk in the investment always go for securities which give assured returns. Personality of an individual also affects their investment behavior. Now, personality is the set of habitual behavior, cognitions, emotional patterns that evolve from biological and environmental factors. The overall personality of an investor is also one of the factors which determines the behavior of the individual to choose among the securities. Income level of the person. There are some investors who depend upon the return of investment for their living. If investment returns are major source of income, so investors do not take more risk. Objective of investment. Another internal factor which affects the behavior of an investor is what is his objective of investment. Whether the objective of investment is safety or growth or meeting any future liability or tax saving. Then comes the external factors. Now, these factors are not in control of the investors. These are the factors which affect the decision of an investor because of external reasons. These includes peer pressure. A person is influenced by the social environment in his surroundings. If his friends or colleagues are talking about their investment and its benefit, it will certainly influence you while investing in that. Market movement also affect the decisions of an investor. How the market is behaving. If the market is going upward and you want to invest money, so everybody will suggest you that it is not the right time to invest the money. So each investor wants to see their investments to grow with time, and that is why they do not want to invest in securities which do not give enough return due to their weak position in the market. Now, company's financial position also affects the your decision making towards the investment. Company's financial position with respect to if the company is earning good profit, what is the asset position of the company, how much capital return on investment company is providing, that affects the investment decision. Then comes the economic situations. The overall economic situation of the country affects the industries irrespective of their operations. If the economic situation of a country is healthy, then the stock market as a whole will also go up, making all the securities beneficial. Family pressure. Your investment decision also depends on the number of dependents you have in your family. Expert opinion. People who do not have much knowledge of securities and investment, they often look towards the advice of their fund managers and analysts with the opinion that they know the market better than them. Now, what are the factors that influence the personality of the investor? These include biological factors. Now, these biological factors are the biological characteristics of an individual and is a combination of various factors. For example, your heredity. Heredity is responsible for the biological structure of any human being. Your physique. Physique is made up of genetic and environmental factors which determine his potential. The endocrine glands like thyroid gland, any disturbance in these glands can cause tension, diseases, mood swings and overall health of a investor. Parathyroid gland, disturbance in this hormone can cause emotional instability, various deficiencies and irritation. Pituitary gland, it causes growth. If this hormone is released more, it leads to more growth, and slow hormone causes less growth and short structures. Adrenal glands, adrenaline is released in times of great emotional stress. Nervous system, our nervous system also defines our mental abilities, motor skills and thus influences overall personality. Gender norms as defined by the society also affects the personality of an individual, like girls can do this, boys can do this. So, if there is a categorization in any societal culture, so it is meant to be affecting their personality. So, we have seen in various states in India as well that there are states like Haryana where we have seen that girls have also outshined in sports, because maybe the preferences of the societal norms are such that they do not mind if girls do enter into the sports activity. Then there are environmental factors which affect the investor's personality. The personality is affected by a stimulus and response which somebody will receive and give during various stages of life, which is known as environment. So, the environmental factors include our home. Home is the place where home gives the first education to the child. So, personality of an individual is dependent upon parents' behavior, his education, his attitude, family culture and attention which is given to the child in the family. School is another important environmental factor which affects the personality of a child. School plays a role for socializing, where you try to mix up with your peer group and you try to have early experiences of life, that how you have to share things, how you have to play with them, how you have to discuss with them. So, all of these things, lot of learning school provides to our children. Then comes the early experiences. Personality of a person who is born with a silver spoon in mouth or somebody who has faced a lot of hardships in life will definitely have different personality characteristics. Success and failure. How many times somebody in his life has seen success and failure can also determine one's personality. Success motivates an individual and make him confident, and failure can lead to inferiority complex or undermining the self-concept about himself. Self-image. Self-image defines one's confident decision-making ability and how somebody looks at life as a whole and looks at his capability for taking any decision.
Then comes the cultural factors. Cultural factors define the norm of the family, the social groups, and can define attributes like independence, whether aggression is allowed or not, whether somebody is cooperative, somebody is spiritual, what kind of religious values you are carrying. Social factors also influence the personality of individuals. Various social setups in which an individual operates, including school, friends, colleagues, peers, relatives, they play an important role in transforming personality of an individual from time to time. Societal norms, they define the boundaries related to behavior, habits, action, reactions, which are acceptable by that society. So we can see that personality of people across various countries or various places or various states within India also, you will find there is a difference in the personality of people. Third type of factors are situational factors. Now, situational factors play a role when a person come across various situations in life which can modify his personality. When a situation arises, our actions, how do we react to it, and our interpretation about those actions or those incidents which has happened to us determines our personalities. It affects our learning, it affects our attitude, mood, knowledge, and overall behavior in all aspects of life. And that same behavioral traits, we will find that we see those behavioral traits when we are investing money in the market. Now, psychology can be defined as a study of human behavior and mind. The study of psychology is important in order to understand the investing behavior of the individual. Investor is a human being who is driven by what he feels, thinks, and have experienced in the past. So, we'll talk about the characteristics of successful investors. For having a better understanding of the behavior of a person, it is important to understand their state of mind. Now, psychology will embrace all aspects of human experience and help to gain a better insight toward rationality of human behavior. This is what we are going to talk about, that what are those traits which make somebody as a successful investor and somebody as not so successful investor while taking investment decisions. Warren Buffett, who's a very popular investor, and he is known for his investment strategies which he has formed, he has suggested 15 characteristics for successful investors. Investors are proactive learners. An investor should not give up learning if he wants to succeed in his investment. They should keep on reading the stuff in magazines, journals, newspapers, and keep on updating the records. They should be always ready to grab knowledge from wherever they get, even if they have to pay for it. So, one important aspect of investment is that one should always focus on learning new things about the investment, how markets are behaving, how economy is moving, and how other aspects are getting affected by it. So, one must understand the relationship, the correlations between all those aspects which are related to it. Whenever we want to invest our money, we should have a planned exit strategy in mind. One should never make investment wait for long if it is not worthwhile. So, every successful investor has an objective of entering into the market, and similarly, they should know when they should exit from that. So, whenever you have to invest money, your target should be that you should have certain goals in mind, that this is the purpose for which I am investing money. Now, this goal can be safety, can be growth, can be earning regular income, can be fulfilling some future expectation of the future monetary requirement. Then, once you identify that this is my goal of investment, one should focus on what is my attitude towards investment. Once you understand that this is my attitude, that this is the amount of risk I am ready to take, or this is the way I am going to take my decision, whether I am going to take my own decision of investment or somebody else is going to help me in taking a decision with respect to investment. So, all these aspects which we have just covered in the today's discussion that the investor behavior, which is influenced by the internal factors, the personality of an individual. Now, personality is affected by the biological factors like your hereditary factors, your physique, various hormones which play a role in your body, the nervous system, whether you are stressed out or not, how do you take life, whether you take a positive attitude in life or a negative attitude in life. So, all of these things affect the biological or form the biological characteristics of our personality. Then comes the factors like the situations which we come across in life. Now, these situations can be, or these environmental factors which affect us can come from our peer group, can come from our home, can come from the culture, can come from the society, and can come from other people who are other situations which we come across in life. So, all of these together form the personality of an individual. So, after these identifying, after you have become a certain type of personality, understanding your own self is very important while taking any sort of decision in life, and also true for investment decision in life. Now, the factors which affect your investment decision can range from factors like how other people are taking decision, can also be affected by whether you are taking an expert opinion for taking decision or not, and are also affected by the peer pressure, the market conditions, and ultimately you end up taking a decision. Later on you see that whether your risk has been covered, you come up with a success or a failure. So, that is what we have summed up till now. And over to you, Gitika.
With this note, thank you, ma'am. Thank you so very much for giving us this session, a productive session where we believe all the students who might have watched us or are watching us would have gained maximum knowledge. Friends, you are requested to be with us as we are going to be back after a short break, and we are going to give you more and more of knowledge. Thank you for watching us. A very warm welcome to you all once again, dear friends. As you know that today we are talking on investor behavior, and for the discussion on the topic we have with us in our studios Dr. Divya Varma-Ghakkar. Dr. Divya Varma-Ghakkar is Assistant Professor in School of Management Studies, Guru Gobind Singh, Indraprasth University. Friends, we know that you like our lectures and your continuous feedback helps us out to give you more and more of knowledge on various topics, and here we are once again to give you maximum knowledge. Friends, we believe that you have lots and lots of questions in mind, and you persistently think that if you would get answers to your questions would be beneficial to you. Friends, if you wish to become part of this live session, then do call us through our toll-free number. Our number is 1-800-110-430. You are just requested to call in the last 10 minutes of the lecture only, as well as you are requested to ask questions relevant to the topic, that is investor behavior only. Now I would like to welcome our guest Dr. Divya Varma-Ghakkar once again and would request her to continue further. Hello ma'am.
Thank you so much. Thank you so much. So friends, we were talking about investor behavior in the previous session, and investor behavior or personality of an investor or investor attitude do affect the way somebody takes decisions. There are various aspects of what forms behavior of a person. So a behavior of a person is a mixture of, you can say, the personality he is. Now personality is affected by various biological factors, environmental factors, situations somebody has seen in life, and these aspects which form the personality of a person. Apart from that, every investor will have certain objective in mind for which he is investing money. That objective in mind can be related to safety, it can be related to growth, it can be related to saving the taxes, or the objective of the investor can be related to having liquidity. Apart from that, there are factors which influence the investor behavior. For example, the environmental factor, the market conditions, the way other people are investing. For example, sometimes there is a boom situation in the market, few people start buying a particular stock or a share, and everybody else starts following them and start buying the share. The reason is unknown, so this kind of a behavior is known as herding behavior. So we follow a herd mentality. If one person is buying something, everybody feels that, if he is buying it, there must be some logic behind it. So let us also buy this particular share, and like this there is a buying spree in the market, or everybody starts buying and the prices go up. Similarly, there can be a selling spree in the market. That means when some few influential investors, let's say, have started selling a particular share, so it happens that everybody starts following them and everybody wants to sell their share in anticipation that there will be some sort of panic, or there may be some sort of bad news which is coming to the market, because of which they have disinvested. So let's also sell our shares. So this kind of mentality is herd mentality. So investor behavior is also affected by all these external market factors. Apart from that, media, when they talk about, or when experts speak about some particular shares or some particular investment avenue, it do affect the way investor is behaving or the way investor is investing in the market. Now, talking about that, we were talking about the characteristics of successful investor. Now, successful investors, they learn a lot. That means they are studying from various sources about various investment alternatives, and from time to time they keep on updating their portfolio. They also have a planned exit strategy. Let's say whenever you are investing money, you should have some financial goal, that this is my return expectation. I want to earn from this market 25%. As soon as I will get 25%, I should sell my shares. Or if I am a long term investor, maybe after 5 years or 10 years only, I would look at my investment and see that how much it has grown and get the returns. But if you are a short term investor, like you are investing for a short period of time, less than a year, then maybe you should have some exit strategy in your mind, that whenever my returns are going to get this much, I will disinvest from the market.
Investors, successful investors are patient investors. That means they invest in securities very carefully and they also allow their securities to grow. They have strong emotional control. Everyone knows that market moves majorly on sentiments, and it's not the market forces but the investors who will drive the prices of the security. So one should not follow the herd mentality but should look at the situation independently and then take a decision which is not based on some emotions. One should have a well-defined investment strategy, or we can say the successful investors do have well-defined investment strategy. So once you have designed your strategy, maybe you will not be looking at how other investors are moving or what is the herd mentality going on in the market, but you will stick to your strategy. Successful investors should thrive on risk. So small percentage of risk is very important for everyone. So otherwise getting a return at a future time will not be as much we are we expect it to be. So little bit of risk is very, very important. If you invest in a risk free security, then your returns will not be too much. Successful investors are disciplined. Successful investors, they are strict with themselves when it comes to investing. They include investing as a daily habit and follow it as a routine. Successful investors also use leverage to their advantage. Now friends, what is leverage? Leverage is a concept of using borrowed capital along with your own capital so that it gives you extra returns as compared to what you would have got if you would have used only your amount of money. Because borrowed capital is always a cheaper source of finance. So students of finance would understand that when we are calculating the cost of capital of various sources, so borrowed capital is a cheaper source of finance. So using borrowed capital has its own advantages and it can bring return on investment or return on equity to be very high as compared to when you are using only your own money. So use of leverage should be one should have a strategy of using some sort of leverage. An intelligent investor borrows fund from others and takes his margin by investing the same in the security after returning the borrowed fund to the lender. Successful investors do learn quickly from their mistakes. Committing mistakes is not a mistake, but learning from them is not learning from them is a bigger mistake. Successful investors are focused. One should be focused in your investment. Putting legs in every opportunity here and there will not result in any kind of gain. So it is always better that one should wait for the next best opportunity and should try to be focused with your strategy. Use trend to their advantage. Difference between an average investor and a successful investor is that average investor fear from fluctuations in the market, but successful investors are those who welcome these fluctuations because they know that they can make money from such fluctuations. Such investors are persistent. They are persistent in their investments. They do not like experiments in investment combination if they are getting enough returns from their previous portfolios. They do take help of team of professional advisors. Professionals are much more experienced than normal traders, and successful investors never underestimate the predictions which are given by experts. Instead, they listen to what expert says and make their move accordingly. So one should keep your eyes and ears open before you are investing into the market and should look at what are the expert opinions on it, and then accordingly have your own strategy and decide about your investment. Successful investors do have strong financial background. So one would, in that case, one person is in a better position to analyze and interpret the situation. They are passionate about the game of investing. Passion drives the man to do what they want to do. If you are passionate about investing, you can obviously make money from it. Now there are behavioral biases which do affect the investor behavior. Now these biases can be classified as cognitive biases and emotional biases. Cognitive biases are those judgments which are made from inferences drawn from what an individual thinks in his mind. Emotional biases occur when people listen to their inner instinct and make their judgment according to that, instead of applying facts and logics. Now, what can we learn from all these concepts related to investment behavior, or what are the managerial implications for investment managers? As an investment manager, if you are managing funds of your clients, or if you are managing your own funds, then first thing first, one must understand the investment objective. So, what is the investment objective with which I want to pursue my goals, or what is the investment objective of my client? How much is the risk taking capacity of the individual? Whether the individual is risk taker or risk averse or risk neutral. So, one must identify it, maybe through a risk profiling inventory or a questionnaire. One must look at the total horizon of investment. Is it short period investment or long period investment? So, what is the total period over which the money has to be invested? After that, one must understand the personality trait of the investor, which will help you understand his attitude and general investment choices. Now, these personality traits can be identified with the help of various personality tests which are available in the field of psychology. So, various psychologists carry these tests very easily, or these are available online, where you can understand what type of person you are, and based on that you can take decisions related to your investments. Another way of looking at things is your demographic factors, also known as investor profiling. What is the age group? Now, people who are younger in age have more risk taking capacity as compared to people who are older in age. So, if you are a middle aged person, then maybe your risk taking capacity is maximum, because at that stage of life maybe your income is also maximum. So, with that highest level of income, you can always take high amount of risk because you have an age advantage with you. Then whether you have some diseases or not, that also do affect your risk taking capacity. If you are you do not have any sort of diseases or not affected by having any health issues, then maybe your risk taking capacity will be more. Whether you take stress of investing money in the stock market or not, that do affect your investment choices. Gender of a individual. Now, gender also, many studies have happened which have claimed that gender of a person, whether somebody is a male or a female, does affect their decision making. It is found in studies that women are less confident and men are overconfident while taking decisions. Now, if that is the scenario, then in that case, your decisions will, or your investment choices will be made accordingly. For example, we have seen in some part of Indian society that women is not empowered or is not allowed to take financial decisions. So, if that is the scenario, so in that case it will not be good for an investment advisor to start convincing or making phone calls or convince a woman that she has to invest her money in such a way, because she has maybe no say in investment. But there are families where there is a lot of say of women while taking investment decisions, and there are very successful women who do take their own financial decisions with the help of their investment advisors. So, in that way, gender do affect or has a role to play. Now, what is your family background? How many family members are there? How many are dependents? And whether you belong to a rural family or an urban background, or all such family related demographic factors do affect your, let's say, spending power. It also affects your savings and rate of investment. And it also affects like who in the family is taking decision. If you belong to a Hindu undivided family business type of firm where all decisions are taken by the head of the family. So, if that is the scenario, then maybe the head of the family only will be taking decision, and depending upon his age group he will decide that how money has to be invested. But if it is like decentralized and everybody has a free hand in taking financial decision, or everybody manages their own money, then maybe you will have a mix of portfolio of investments which are accumulated in the family. Your marital status also affects your investment behavior. Now, if you're married or you are unmarried, so if you're earning well and you are unmarried, then maybe your risk taking capacity is more as compared to when you are married. And if you are married, then how many dependents you have, that do determine. Sometimes studies have also found that married people do have more risk taking capacity as compared to, or risk taking nature as compared to the unmarried people. How much is your income? Which income group do you fall in? Out of the total income, how much you save, how much you spend. So, what is your saving rate? What is your investment rate? How many dependents you have? If you belong to a high income society, then maybe your style of investing money will be very different as compared to somebody who has started earning very recently and does not belong to or is a middle class person who's investing money. So, their style of investment will be totally different. So, all of these factors, the demographic factors, also affect any person's investor behavior. We need to also understand the return expectation of the investor from the financial market. When you are investing money, you have certain target in mind. If your investment objective is safety, so in that case you do not want to earn a high return, but you want your money to remain safe. So, in that case, maybe investing in a PPF or in a fixed deposit will be a good idea for you. But if you have a return expectation of, let's say, maybe 10 to 20% from the financial market, then maybe your investment advisor will suggest you that you should either invest in mutual funds or in equity market or in government bonds. So, whichever rate you want to expect from the market. Then next step is to evaluate various behavioral biases which are affecting the investor and design strategies to manage these biases. Each one of us as an individual, as a part of our attitude, has formed certain type of behavioral patterns which are affected by the cognitive factors and the emotional factors in our life. Now, these cognitive factors, cognitive factors are those which are affecting us because of our the logic, the calculations, the knowledge which we have gained over a period of time. Now, they also affect at the back end, they work in our mind and while taking any sort of decisions. Then there are emotional factors which affect a person while taking any sort of decisions. For example, in the emotional factor, like some people have internal locus of control, but other people have external locus of control. Now, locus of control is that to whom do you put the onus or responsibility of whatever happens with you on. Now, if some people who have an internal locus of control, so whatever good or bad happens with them, they believe that it has happened because of me, it has happened because of my decision or my choices. But somebody who has an external locus of control, you will find that such a person will always be blaming somebody else, like because of this friend, or because of my investment advisor I have incurred a loss, because of my parents this has happened to me, because of somebody else something has happened to him. If not anybody else, then because of God it has happened to me, it was not my fault, it was not my choice. So, those people have an external locus of control. Now, if you have that kind of personality trait, so it's a bias, the way you look at things and the way you interpret things, so it do affect your decision. When you have an external locus of control, you are learning, or you can say your learning from your mistakes is very less as compared to when you have an internal locus of control, because you start introspecting when you have an internal locus of control, that why it has happened to me, where I was wrong, how I could have improved. So, in this way this locus of control concept operates. Similarly, we can have a framing bias, wherein the way things are presented to us, that does affect your decision. at any point of time. So, if things are conveyed to you in a positive manner, maybe you will have a certain way of deciding about it, but if things are presented to you negatively, then maybe your decision making will again be different. So, if framing or the way things are presented affects your decision, then you have this particular bias which need to be managed. After understanding that what type of biases a particular investor is having, a particular client is having, you can identify, you can at least inform them, or one should be aware about that, this particular bias I have. I am very overconfident, I am very optimistic, or I am over optimistic, or I am affected by loss aversion. So, accordingly my decisions need to change. Finally, keeping a frequent and open communication with your client is very, very important. From time to time there should be a conversation, or one should look at the portfolio one person is managing, because that does affect your future returns, and it also helps build the trust and confidence between you and your investor, the investor. Apart from that, taking rational decisions all the time, they are influenced by cognitive and emotional biases. So, ultimately what happens that sometimes when wrong decisions are taken, it is because of some of the biases which are affected to us. So, proper awareness of oneself and the behavior of your client can help avoid such mistakes, and you can take appropriate actions related to it. Next comes the cognitive biases. Now, these cognitive biases, when they are affecting an individual personality, so these cognitive biases can be categorized into 4 categories. These are the biases that can arise from too much information which is available to us. They are biases which can exist because we could not generate much meaning from the whole information which is available. There are biases which occur because we need to act very quickly, and then there are biases which happen because of the limits of our memory. So, all the cognitive and mental abilities which a person possess, so any bias which arises because of the knowledge, because of our calculations, logic, rational decision making, so all of these cognitive biases, they are generally, in some other session we will talk about these biases specifically in detail, but generally they are classified into these 4 categories. Now, information overload sucks, so we aggressively filters. Sometimes noise also becomes our signal. Lack of meaning is confusion, so we fill in the gaps and signals become a story. We need to act fast lest we lose our chance, so we jump to conclusions, and stories can become decisions. Ultimately, the decisions inform our mental models of the world. In order to avoid drowning in the information overload, it is recommended that our brains need to skim and filter insane amount of information, and it should be done quickly, almost effortlessly, and decide which few things in that fire horse are actually important and call those out. So, while dealing with these biases, in order to construct meaning out of the bits and pieces of information that comes to our attention, we need to fill in the gap and map it to all our existing mental models. In the meantime, we also need to make sure that it all stays relatively stable and as accurate as possible. In order to act fast, because when we are affected by biases and we have to take decisions, our brains need to make split-second decisions that could impact our chances for survival, security or success, and feel confident that we can make the things happen. One must remember that useful bit of new information and inform rest of that which part of the information is useful, which part of the information is noise. So, we need to identify it and we need to segregate it for taking any sort of decisions. Sometimes when we are taking quick decisions, they can be flawed. So, it is always recommended that we should not jump to our decisions quickly, but we should look at things very logically before taking any decision. So, finally, I would like to say that investor behavior is the most important aspect of individual decision making when it comes to investment decision making at the individual level. So, one must understanding oneself is very important. So, all of us, when we are taking any type of decision, so out of all decisions of life, investment decision is also one type of decision which we take in life. So, if we understand that what type of person we are, what is our attitude, what is the things that affect us in life, what are the emotional biases we are affected with, what kind of emotional person I am or you anybody is. So, if we understand ourselves better, then while taking any decision we will be aware of that these are the limitations or drawbacks or biases which I am affected with whenever I have to take decisions. For example, from a car driver, if you will ask that if there is an accident which happens, that whose fault it was, nobody will say that it was my fault. Everybody will put the blame on the other person. Or while driving, we never have this thing in mind that I can make a mistake of taking a wrong decision. So, it is something which is known as an overconfidence bias. So, like this, there are various type of biases or misperceptions or things we are affected by in our life, and one must understand oneself or understand their own behavior before taking any type of decision, because while taking decisions, the environmental factors are going to affect those biases which we have, and they are going to make an influence on our decision. So, logically all decisions should be taken. There should be a proper investment strategy before taking a decision, and from time to time the information should be filtered, and one should take decisions based on all the well planned strategy and all the information pieces which are available, and noise should be avoided from it. And finally, the kind of decision such an investor will come up with will be a successful decision. So, that is all for now.
With this note, thank you ma'am, thank you so much for giving us this session where you have beautifully exemplified the entire topic. Dear friends, we believe that you might have gathered lots of information and you have questions too. So, do write to us at info.cec@nic.in, as well as you can post your feedback too. We are taking your leave with the promise that we are going to meet soon. Till then, take care. Goodbye. Thank you ma'am. Thank you once again.